Let's now take a look at the typical cash and tax benefits allocations we see for wind projects in the US. In a pre-flip period, the tax equity investor typically gets 99% of the tax benefits and 20% of cash benefits. In a post-flip period, the tax benefit allocation goes down to 5%, and cash benefit allocation goes down to 5% as well. This is how typical allocation for the tax equity partner looks like in a wind project. However, this allocation varies on a deal-by-deal basis. Note that according to the IRS tax rules, the partners have to maintain a minimum of 1% interest in both tax and cash benefits. Therefore, 100% of tax benefits cannot be allocated to the tax equity partner. So, how does the allocation of cash and tax benefits look like for the general partner? Well, it will be the opposite of the allocation to the tax equity partner. Pre-flip, 1% of tax benefits and 80% of cash benefits will be given to the GP. Post-flip, it is 95% of both tax benefits and cash benefits. Note that the tax equity partner has to maintain the 5% interest in profit and losses in the post-flip period. Let's now take a look at the cash and tax benefits allocation for the solar projects. In solar projects, we typically have two pre-flip periods. The first pre-flip period is the first generation quarter. This is when the solar project can claim the investment tax credit. Usually, in the first pre-flip period, we allocate 99% of the tax benefits to the tax equity partner. In the second pre-flip period, we allocate 67% of the tax benefits to the LP. And, similar to the allocation for the wind project, the tax benefit allocation drops to 5% in the post-flip period. The reason why the allocation drops from 99% to 67% in the second pre-flip period has to do with the IRS rule that tax benefits allocated to the party cannot exceed his capital investment into the project. The cash benefit allocation is 20% in both pre-flip periods and drops to 5% in the post-flip period. The cash and tax benefits allocation of the general partner is, again, the opposite of the allocation to the limited partner. 1% of tax benefits go to GP in the first pre-flip period, 33% in the second pre-flip period, and 95% in the post-flip period. 80% of cash benefits go to the GP in both pre-flip periods and increases to 95% in the post-flip period. Now that we have reviewed the allocation of benefits to the partners, let's introduce the debt financing for the project. After all, this is a project financing transaction. We again start with the partnership, which develops the renewable project. The tax equity partner, which is a limited partner, invests equity in the project and receives the tax benefits from the partnership. The general partner is typically a holding company, and the project sponsor invests equity through this holding company. Now, the partnership can raise non-recourse debt, and this would be a project-level debt. However, you rarely see project-level debts in tax equity structures, because tax equity wants to avoid having debt in the partnership. If, for some reason, lenders foreclose the asset, this would be a change of ownership and subject to investment tax credit recapture by the IRS. In other words, the tax equity investor would have to give back some of the ITC to the tax authority if the change of ownership happens within 5 years, which would reduce the tax equity returns significantly. For allowing the debt at the project level, tax equity investors require around 10 to 12% IRR compared to 6 to 8% IRR without the debt at the project level. So, what happens in reality is the holding company, which is a general partner, raises the debt, and this is called a back-leveraged debt or back-levered loan. The back-levered lenders take the sponsor's equity interest in the holding company as a security for the back-levered loan. So, the cash distribution from the partnership that goes to the GP goes first to satisfy the debt service and then pay the dividends to the project sponsor. The question is, how much each of the parties contribute in financing? Typical percentages are 40 to 50% come from the tax equity investor, 20 to 40% come from the back-levered lenders, and the remaining comes from the project sponsor. In the last two lessons, we reviewed the basics of the tax equity concepts, and in the next few lessons, we will introduce the simplified version of the tax equity funding to our model.